Good afternoon. Welcome, everybody. It's a pleasure to be able to share the latest insights again with you. I hope you all managed to get a good Eid break as we now head into the second half of 2023. My name is Bahoshy. I'm the CEO of MAGNiTT, and today I'll be sharing an update on the emerging venture markets and the latest state of affair of venture capital across the whole of the region. The structure of the presentation will be that I will actually have quite a lengthy presentation today, which I hope you find insightful, which will take about 20-25 minutes, and then I will open it up for Q&A. Please do share any questions that you have in the chat box or in the Q&A box. Someone from the team will share them with me, and we'll try to get through as many as possible. And in that case, I will jump straight into it. Start off with, for those of you that may not be familiar, MAGNiTT is a platform that fills the VC data gap. We effectively cover the geographies of the Middle East, Africa, Pakistan, Turkey, and Southeast Asia. And our goal is to create transparency and information around the growth of the venture capital markets in that space. We will provide a little bit of an overview of the global macro recap, which I haven't necessarily done before. And the idea is to give a high-level picture before double downing into the MENA macro picture, and then specifically into the EVM venture highlights and the market. So to understand what's happening in this time of the world, it's important to understand what's happening globally. So a couple of key things: market surge, interest rates, employment, trade, oil prices, debt levels. And the biggest challenge that I personally have is that there's a lot of conflicting economic indicators versus what's happening in the venture capital space. For example, if we were just to look at the public markets, you can see that looking at the two indices in the US, NASDAQ has seen, and this is just as of 30th of June, and it's further increased, a 32% increase from year to date, and S&P 15%. So if you were to look at just the public markets, you would see some positive activity that's happening, specifically in the tech stocks. And that's why you've seen this growth. In fact, 7 different companies, all of which are predominantly tech companies, accounted for 75% of the growth of the S&P. And if you were to strip out that from the rest, it's a 3.82% contribution for that rise. So you can see that the tech stock rebound that was seen in the first half of this year, almost the recovery of the complete decline in the tech stocks that was seen last year, not necessarily representative of the rest of the economy. In fact, if you looked at other sectors, here are other indicators of the economic environment that we're in. Brent crude down from the highs, and I'll come on and speak to that in a little bit more detail. Regional banks, complete collapse, with the likes of SVB being one of the highlights. Transport stocks, retail stocks. So the wider market has seen massive declines compared to previous years, but technology continued to boom, and many analysts will point to the fact that that's the AI revolution that is driving and hyping up many of those companies. A lot of the rhetoric in the first 6 months of this year was talking about inflation, and people were talking about how high inflation was becoming a concern for economies. Well, as of only a couple of weeks ago, inflation in the US reached the lowest level of 3.97 in 12 months. But interest rates currently at 5.25, and with the FOMC meeting coming up, is likely to increase as there are systemic issues that the Fed is looking to still try and resolve. And hence, interest rates globally, reflecting some of the activity that's happening in the US, remain high. A question that has been posed to me this week as I've been presenting to many senior officials is many of the impact of the venture capital market driven by higher interest rates. Well, the rhetoric that's coming out of the US is that interest rates will continue to rise further in the months ahead. And as Chamath Palihapitiya will say, they're likely to be higher for longer. So this environment is not likely to slow down. What does that impact? On the left, you can see consumer credit card balances reaching some of the highest levels that we've seen, dating back to 2004. And in fact, the interest rate of credit cards is reaching higher and higher levels as interest rates continue to drive up, which can have systemic issues into the rest of the economy. Something that not many people are even talking about, the money supply, the M2 money supply, the amount of liquid cash and money in the circular system has seen the lowest levels since 60 years. Something that is alarming for people that are looking at some indications that the US market is going to move into a recessionary environment. And yet, counterpoint, US unemployment is currently at some of the lowest levels. So I highlight all of this not to try and be an economist, but to say, if you are to read the headlines of some of the biggest publications at a macroeconomic level, there continues to be contradictory points, economic indicators on the state of the macroeconomic global environment. What about in the MENA region? Because we're looking at some of the MEAPT environments. Well, if you were to look at slightly more regional data points, commodity prices, although continually fluctuating given geopolitics, are at lows, as I mentioned, compared to last year. You are seeing positives. UAE non-oil growth has continued to go out throughout the year. You are seeing legislation such as corporate tax coming into the UAE, diversification in Saudi Arabia of the non-oil private sector. Egypt saw the sale of state-owned companies like the telecom to try and provide further liquidity in the market. And the Egyptian currency has definitely seen depreciation. So when we look at some of those indicators, as I mentioned, WTI crude, you can see a 40% drop off the highs. So while there is a lot of positivity around some of the GCC and oil Gulf countries, you are seeing that the highs of 2022 have seen a 40% drop. But non-oil trading and indicators show that there continues to be growth in that private sector market, both in the UAE and in Saudi Arabia, so that there is diversification in those economies. But as I mentioned, a lot of talk around what's happening in Egypt, and almost close to 60% devaluation of the currency that has definitely hurt the local market. So again, conflicting messaging coming out of macroeconomic indicators. What are some of the highlights that we've seen with regards to venture capital? Well, in Q2, since the last time I did this presentation, we've begun to see, despite the announcement, for instance, of a 5-year tax exemption for startups in Egypt, a migration of companies moving away from Egypt towards hubs like Saudi Arabia and the UAE. We've definitely seen, if you read the media, an increased interest of international investors coming to the region, the likes of Jason Calacanis. We've seen Brad Gerstner coming to the region. You've heard about Dalio coming to the region. Many of the largest VCs have been doing field trips to come and meet the sovereigns. So from that perspective, positivity, all of whom are looking to potentially raise funds from the region. You've seen programs like the NTDP of unicorn programs coming out of Saudi Arabia. Continued interest from Southeast Asia, state visits of China and South Korea, as well as delegations from Singapore, along with my visit to Singapore to understand the venture corridor that exists across the two economies. Many fund announcements, which I'll share later in the presentation, and many announcements from the PIF and ADQ of investments that they are making internationally as well as in the region. So some positivity from a media perspective of the venture environment. But let's get down to the numbers. I think that if we look at the high level figures, how do we compare to the rest of the world? H1 2022 compared to H1 2023, emerging venture markets. MAGNiTT covers Africa, the Middle East, Pakistan, and Turkey. So we start with those figures. A year-on-year comparison shows that total funding, which is close to $2 billion, is 64% lower than last year, with 530 deals being 40% lower than last year. What are we benchmarking against? Let's look at the US. Looking at capital, 44% drop in invested capital. So not completely dissimilar to global markets, with a lower percentage drop in deals. Europe, a 60% drop in capital. All of these figures coming in full transparency from CB Insights for benchmarking purposes. If we then venture towards Asia and LATAM, other potentially comparable emerging markets, you're seeing the same, a drop of 60% in capital, and in LATAM, a 74% drop. And when we push into what happened in MENA, as you can see from this chart, each of which is the first 6 months of every of the last 5 years, a 40% drop in funding and a 50% drop in deal transactions. But what you can clearly see is that mega deals accounting for company deals investments of $100 million plus, about 50% of the amount of capital that was being deployed. So still heavily skewed towards those mega deal transactions that I'll come on to. Africa, similar figures, as I mentioned, a 54% drop in funding and a 50% in deal flow. So the point here, positive, negative, depends how you want to look at it, is that the venture activity that's happening here in the region is not in isolation to what's happening in the global markets, a point that has been stressed by many of the delegates and the senior officials I've been speaking to this week. So to take some level of comfort, we are not out of sync of what's happening on the global market, albeit potentially out of sync of the mixed macroeconomic indicators that we're seeing from the rest of the economy. And as you can see here, a bit of a comparison. What am I going to be pointing to in this presentation? I'll just give you a quite quick high-level summary of the 6 points. Number 1, regional VC investment mirroring global trends. Number 2, early stage investment still seems to be the focus, despite a drop of invested capital in that space, with a 34% drop in Series A valuation. Saudi Arabia leads the way by capital deployed, while Turkey leads by the total number of transactions of the geographies that we cover. Fintech as an industry still remains the most popular, despite the cool-off in investment. While we've mentioned that international investors have been flocking to the region to meet sovereigns, there has been a cool-off in investor participation in the region. And contrary to predictions, M&A activity is a lot more muted than expected this year. So to jump onto it and then to double-click into some of the points that I mentioned. Here you see the quarterly evolution of funding and deal flow across the EVM, again, the aggregate figure for Africa, the Middle East, Pakistan, and Turkey. And you can see that Q2 of this year was the lowest deals since Q4 2018 and the lowest funding since Q4 2020. Again, what was Q4 2020? If we look at 2020 as the year of the onset of the pandemic, which pretty much coined as February, March of that year, and we know that it takes 6 to 9 months for a round of funding to come to fruition, it is the lowest impact of that period of COVID. And we are now seeing funding mirroring a similar amount to that period. Again, benchmarking against global data trends according to CB Insights, the lowest deals according to global figures, Q2 2017. But again, lowest funding dating back to Q2 2020. The biggest difference between our two charts, and I've mentioned this in previous webinars, the peak of the funding liquidity push was Q4 2021 in global figures. When we look at our figures, it was Q1 2022. So a 1 quarter delay, either in reporting, announcements, or deals that were being signed in the emerging venture market space. One other alarming thing, this is the first quarter dating back to Q4 2020 that a mega deal, an investment in a late stage startup of more than $100 million hasn't taken place. Again, a reflection of investor appetite in the current market and the risk-off mentality of late stage investment. And if you strip that from the EVM, you can see that it's the 5th consecutive decline in capital in deals that don't include $100 million. Again, another somewhat red flag of the current state of affairs of venture in the region. If you look at the MENA market, not completely dissimilar to trend, somewhat more fluctuations given the mega deals that you see, but the deal flow does reflect, similar to the global trend, investments at its lowest level dating back to Q2 2017, with funding being the lowest again at Q3 2020. Africa, another geography that we continue to track, very similar trends, with lowest deals in Q4 2018 and lowest funding dating back to Q2 2021. So again, the positive, if one can look for it here, is that the trends are not completely dissimilar to what we're seeing from a global perspective. In fact, all the indicators show a drop in funding in the H1 period compared to year on year, reflecting the actual sentiment for this in general. The only interesting one to point out, Turkey, early stage investment, seems to be the driver of a flat deal flow compared to the year before. And similarly, more or less indicating this is the lowest levels that we've seen, as well as a pushback from the rise of capital that was being deployed in 2001 and 2022. One thing I do want to point to, which I think the team has found quite interesting and we've shared before, this chart shows the progressive quarter-on-quarter change in funding for the MENA region. This is taken directly from our analytics tool on the platform that the team can share in the chat if you're interested in visualizing and playing around with. Q3 has tended to be the lowest quarter decline of funding in investment, and that there tends to be a 35% drop in funding compared to Q2. The challenge that we see here is that Q2 of this year already saw an 81% drop in funding compared to Q1. Therefore, are we saying that the funding will be even lower in Q3? Well, as many of us are aware, the two Eid holidays and Ramadan fell for the first time fully in Q2, and therefore Q3 will not have that impact. But at the same time, the summer lull, which tends to be a challenge for the region, is likely to come into effect. I can't predict that it'll be a 35% drop, but currently we have not heard of, or at least announcements of, big deals that are likely to change the needle to reflect an increase in investment. But one positive thing to point towards is as we get into the later quarters of the year, where we see the likes of North Star, GITEX, FII, STEP Conference, and Rise Up, those are usually catalysts of investment announcement and investment activity, as well as the ability to meet investors. So we do predict an uptick going into Q4, specifically in Q1 of next year, but the trend doesn't look to be positive in Q3 by the time we next time do this webinar. People have been asking me, where have we seen investors investing in the current environment? Well, to start with, if you look at the share of the top 5 investments over the last couple of quarters for the MENA, and this is representing the share of the top 5 and the rest of it being the underlying ecosystem, you can see compared to earlier quarters, the concentration still seems to be in these mega deals, but they are only accounting for top 5 deals. When we look at the overall breakdown of investments in this particular chart, the overarching emerging venture markets, you can see that if you aggregate the two bottom colors of 0 to 1 million tickets and $1 to $5 million tickets, that there is an uptake of 3% compared to the same period last year, indicating that investment seems to continue to be within the early stage space. Similarly, when we look at the MENA ecosystem, up 2% or 1%, sorry, in those same bands, against the backdrop of only 193 deals, not 692 that we saw last year. And if we look at Africa, even more is driven into the early stage. So anecdotally, what the data is showing us is that investors seem to be focusing on early stage, less risky, or at least the ability to scrutinize companies that are probably pre-seed, seed, or very early Series A with a product market fit, clear path to monetization. And one thing that's beginning to become interesting is that the round size at that stage has been growing. This is the average round size of the whole of the ecosystem for EVM, MENA, and Africa for mean values. And then when we look at median values, you can see a slight uptick in both MENA and EVM. But what is interesting to kind of highlight and note, and this is again from our platform, where we now have valuations for all investments that are registered and disclosed on the platform, which you can then manipulate using our data tool for both deal size and valuations, that if you look at Series A valuations for MENA-based companies, there is a almost 35% drop in investments at that stage. Even bigger when you look at Series B and late stage, but the number of transactions are a lot smaller. Having said that, similar to global trends, seed stage valuations remain somewhat flat, or albeit in median a 30% rise, but 20% rise. But what we did see is that the deal size in both median and mean for seed stage investments are 30% higher. Therefore, a 20% rise in valuation against the backdrop of a 30% rise in the size. So clearly, investors seem to be giving bigger rounds to help startups weather the economic environment to 24 months or so that the runway is bigger, but the valuations also are correlating to being higher. Series A clearly impacted. When we look at the geographical split, again, a few trends are beginning to emerge. I predicted at the beginning of the year that geographical support and government support will drive investment activity. Turkey, I mentioned, remained somewhat flat in terms of number of transactions, the only one to see a flat record in terms of number of transactions year on year. But the top 10 geographies, on average, saw a 32% drop in deal flow. Second came Nigeria, UAE, the first in the MENA region. But when you look at deployed capital, Saudi Arabia in the geographies that we cover now ranks first, up 3 positions, albeit against a backdrop of 20% decline in funding year on year. In fact, many of them have seen drops in investment activity. And it is important to note when you look at the Saudi figure, 65% of that have come from 2 transactions that were mega deals in Flowered and MAGNiTT. While if you look at Egypt's, which ranks second, 85% of which came from Halan's investment. So a huge skew in a single deal of the underlying ecosystem. And the fact that we did not see any mega deals reported in Q2, further signifying that this investment pace is not likely to continue to be positive in the next quarter, unless there are bigger deals to impact that. In fact, when you look at the quarterly evolution, again, of the UAE, a progressive decline in the last couple of quarters, and Saudi had a low Q2 compared to other geographies. And so I think it's important to benchmark some of these performances. Again, Egypt, where I talked about the depreciation of the currency impacting the ability of startups to raise funds, and many actually migrating to other geographies, saw one of the lowest levels of funding that we have recorded for several years. So clearly big impact on the venture community in Egypt. Again, a high-level overview of some of the geographies that we just mentioned, showing many of the negative signs that we've spoken to, with figures dating back 2017 in terms of deal flow. Quick overview of the industries. Well, it's very simple. Fintech, fintech, fintech. Fintech remains the industry of choice, albeit against the backdrop of a 50% drop in both MENA and Africa in terms of deal flow. But in terms of rankings, fintech does seem to be the industry of choice of investors, something that I don't think is going to be changing anytime soon. This is also reflected in the amount of capital that's being deployed in both MENA and Africa, separated with a 30% drop in MENA and a 53% drop in Africa in fintech. Many people talk and ask the question, what are the hottest industries and are we seeing any changes? The reality is, as the venture capital investment continues to slow down, people are going into industries that they're more familiar with. So fintech naturally being one of the biggest to disrupt. I want to address the point that I keep getting asked, but aren't we seeing more and more investors coming to the region? True, there are announcements that are being made. Here are just some of the announcements of funds that have been launched in H1 of this year. Even the Korean Ministry and the SME of startups doing relationships with governments here in the region. Shuruk's Badaya Fund supporting some of the Korean cross-collaboration. We've seen Novastar creating a fund locally for Africa. So there is positivity, and people ask the question, how much dry powder? The challenge that we have is when an announcement of a fund is made, it is sometimes unclear to know whether that is a full commitment for that capital or whether that's an announcement and that there is a drawdown period by which that can actually be deployed into the market. As well, in this risk-off environment, people can tend to see that if you wait for the market startups that may be struggling, you get better valuations on those companies. So naturally, investors may be waiting to see if companies will see more reduced valuations, specifically at the seed, which I've just mentioned, have continued to raise. But investors also have a time frame by which they need to deploy. So I don't know if you heard the All In podcast the other day, which I listened to. They were talking about institutional investors and pension funds looking at managers needing to invest in the stock market because there are outperformers in that industry and that they cannot stay off the sidelines. People have clearly seen that in this environment, VCs will need to deploy if they do have dry capital. Having said that, the left-hand chart shows the number of unique investors, institutional VCs, LPGP structures, CVCs, and accelerators making investments. Q2 saw the lowest level that we've seen for several years of individual institutions, with an almost 46% drop in investors in the first 6 months of this year making investments. Not only that, a lower participation from international. So while we are hearing the rhetoric that many international investors are coming to the region to raise funds, it is not clear that that is then translating into investments into the region yet. I do caveat that by saying yet. Second, if you look at the MENA region, it is almost the lowest that we've seen. And I looked at this dating back to 2018 with a 33% participation from international investors. So again, the MENA region is not seeing this international participation. And anecdotally, that is definitely affecting late stage investment much more than early stage investment. Historically, early stage investors have tended to come from the region supporting the growth of the bottom of the pyramid. And when you get to late stage investors, there haven't been that many institutional or corporates playing in that space. In fact, we wrote an article recently saying it was the largest participation of local investors at late stage investment that we've seen in the last 4 years, clearly because international investors have supported companies at late stage, which I've already mentioned has dropped off. Very similar situation in Africa as well. There are clearly some investors that are being active, but you can also see from the left-hand side, many of whom have been accelerator programs, looking at Techstars in Africa, Flat 6 Labs, 500 startups with their programs with Sanabo. So the accelerator programs, which is interesting because in the midst of COVID, I made the remark that the percentage of deals that came from accelerators reached the lowest level, because accelerators, tending to be a program where you immerse people in rooms and engage with other founders, went off in the virtual environment of COVID, has clearly returned, and the appetite for investment in that space to support companies to weather the economic environment that we're in has continued to be active. But in terms of companies that have made bigger bets in late stage companies, we are seeing the likes of STV, we've seen the likes of VentureSoup, Chimera in their investment in Halan. But again, not as many as we have seen historically, all of which you can track on the platform by both number of transactions and capital deployed. And the final point that I want to highlight before going into any Q&A, I did predict at the beginning of the year, this would be a record year of exit. The challenge has been that in this environment, and I spoke to several experts in this space, while you assume that's easy to make exits happen, you need a couple of things to happen as well. Number one, you need cash-rich buyers. How many cash-rich buyers are there in this current environment? A second thing that I haven't really alluded to and has definitely come up in multiple conversations this week, the crowding out effect is really playing a big part. And what do I mean by this? I shared in the previous presentation a tweet from David Sachs. Imagine that interest rates reach 5.5 or 5.75% or maximum of 6% before year end, as some people are predicting. That means you can take your cash, an investor or their LP or an individual angel, and go to a bank and potentially get rates of 5 or 6% in the bank. You can even go and get corporates, credit, so loans or government treasuries, etc., at 7 or 8%. It means your expectation of the markets, which I've just pointed out, that the NASDAQ has reached 30% and S&P similar figures already, or close to similar figures already, your expectation has to be 10 to 15% to outperform what you could get in the bank. That means venture entities need to be able to achieve compounded growth of 25% plus for it to be interesting not to put that cash into a bank account. And therefore, when you look at the investment landscape, you can see that that naturally puts people in a risk-off environment, specifically when you're looking LPs into the venture capital community. But when it comes to exits, a similar mandate could be looked at. Is it safer to put your cash into a bank account, weather out the economic environment and potential recessionary impacts that will be happening, or go into potential acquisitions? Well, clearly, that's one of the challenges. Or are they very strategic? What we are seeing is corporates that do have balance sheet, that do have strong fundamentals, making those acquisitions. But it's very challenging for companies that are doing down rounds potentially to look and have a conversation when valuations are dropping. And as such, the activity that we did see from Q3 2021 to Q3 2022, in many cases 40 plus acquisitions, has dropped in the last couple of quarters. And in some cases, more geographies bigger than others. In fact, in MENA, it has been somewhat of a drop in Q4, Q1, a slight pickup in Q2. But in Africa, the data has been a lot more acute than what we've seen in the Middle East and other geographies. Another chart that we track on the MAGNiTT platform through the analytics tool that's quite interesting, the exits, the time to exit from founding to exit has changed in 2021 and 2022, where there were, shall we call it, more investment activity and exits taking place. They seem to be the opportunity of younger companies that allow bigger companies to acquire. We are now seeing a reversion back to more established companies where no doubt founders that have been around for a long time are looking for exit possibilities in this current environment. Before I jump into Q&A, and please do share the questions either in the Q&A box or in the chat box, and I'll come to them, just to share a couple of points on how MAGNiTT can help you right now. We are working with many of our clients, whether they're government, corporates, investors, or service providers, understand the data at this point. And what we've really realized is that now, more than ever before, it's important to understand the metrics. You can use the tools to identify for due diligence purposes, custom market maps of specific industries. We are working with certain clients, and please do reach out to your account manager or to the sales team to have custom dashboards. Every chart that I've shown you here in this presentation can be created on the platform. And for certain clients that would like, as part of an add-on to their subscription, we can have specific dashboards based on your criteria, based on your needs and requirements, and even in your brand color and logos. So if you're preparing presentations for LPs, for management, we can create them custom just directly for you. As I mentioned, there are tabs now on the platform with specific valuation trends. So if you're looking to make investments or due diligence or competitive analysis, you can use this. And as I mentioned in our previous meetings, we have comprehensively captured the Singaporean ecosystem and are now well on our way for integrating Indonesia, Malaysia, Vietnam, Philippines, Taiwan on the platform, which is planned before year end. And other things to look forward to, we've recently launched a beta for People Directory. So you can now have contact details searched by company, but also individuals, a market map of investors, along with updated startup profiles, analysis tabs for founders, and a new feature which we plan to look in Q3 based on historical data. When is a startup likely to be fundraising, so that you can identify companies that you may be looking to want to reach out to. Again, for any of these features that you can use on the platform, please reach out to, and you'll be receiving an email after this, anyone from the sales team or your account manager, including APIs that we can use to create visualizations on your platforms. We'll have 1 or 2 launching with government agencies in the coming months. Thank you very much for registering. As I mentioned, if you have any questions, please put them through and I will start to try and answer them once I can pull up the questions. Great. I've started seeing some of the questions in the chat box. If you would like to share them as well in the Q&A, I'll look to try and get to them as well. What is the hypothesis frictions for international investors to slow down, cooled off in MENAP? Well, as I kind of alluded to, international investors have tended to historically play a much bigger role at late stage investment where there haven't been big institutional investors or larger VC funds in the region that play in that space. So when you look at the likes of Tiger Global, you saw Chimera, you look at SoftBank, they've been much more active at the late stage investment. Now, clearly, in this risk-off environment that we're in, where people are starting to be cautious in the hyper-growth at all cost environment that we see ourselves, it is more likely that they're less likely to participate. The second thing is, naturally, VCs tend to focus on their home markets. So right now, where we see investors looking to shy away from potentially emerging markets, they look to focus on their portfolio companies and they look to focus on their home markets for opportunities. That has driven an environment where international investors have been in risk off. Having said that, look, I went to Singapore. I met probably 10 to 15 of the leading VC investors in Singapore, all of whom, or if not 75% of whom, had planned to come to the MENA region to raise funding from sovereigns. And it's very interesting to hear their feedback following their visits. Each of the sovereigns have been saying, very happy to discuss with you, interesting to understand your mandate, but can you tell us whether you'll be investing here in the region? And it is clear that the sovereigns are keen to see those international investors invest in the region and potentially set up in the region. And therefore, if you're looking to raise from the region, don't assume that it's to invest in your home markets. And anecdotally, I met with GIC and I met with Temasek when I went to Singapore. Those are the two largest sovereign wealth funds based out of Singapore. And I asked them, if a VC in MENA was to come and raise from a sovereign in Southeast Asia, would you allow them to, would you be looking to invest in them to invest in the Middle East? And the answer was very simple. If you're not looking to invest in our home market, we're less likely to invest in you than if you are. And therefore, it is likely that if they do begin to fill their mandates, we will see an investment in activity grow, but likely to happen later in the year. What is your, thank you, Abdurrahman. What is your expectations for forecast of H2 2023 in terms of numbers of deals and money to be raised? Look, I showed you for MENA the chart on the Q3 predictions. I can't say that it's going to be a 35% further drop of invested capital. But what I can say is history has shown that Q3 has not been a strong growth quarter for investment in MENA and anecdotally for the rest of the region. And therefore, I anticipate, based on the high interest rate environment that we're in, that Q3 will continue to be a low funding quarter. Now, I did mention that it is likely to see an increase. But when you see the record levels of investment that took place in 2021 and 2022, you can see that the mega deal contribution to them was very significant. Close to 50% came from mega deal activity. That is to say, if we do not see late stage investment deals, and this is not to say that it won't happen, but multiple late stage investment deals happen, then it is unlikely that a continued focus on early stage 1 to 5 million deals will cover the gap of what we've seen. And therefore, naturally, we're going to see a further retreat in investment activity. What we will likely see is a return of investment activity at the beginning of next year. Angelo asks, is there a difference between family offices investing more along strategic lines aligned to the business of founders versus VCs investing based on investment thesis? Great question, Angelo. I'd love to say that I'm an expert in that specifically. I can assume that family offices are more strategic. And actually, because family offices tend to invest off balance sheet, they don't have an LPGP mandate. So where you have an LPGP mandate and the mandate tends to be 5, 6, 7-year horizons, then those that have dry powder still have a requirement to invest that capital and cannot put that into, for the sake of argument, fixed deposits. If you are a family office where venture capital is an asset class of the bag of investments that you look to invest in, there you are more likely to be risk averse and look into more traditional assets such as fixed deposits or even real estate as an alternative. So their mandate as a family office is likely to be different to an LPGP structure. Do you have a view on how an angel investor ecosystem is developing in the region, pre-seed and seed financing in particular? Is that being backed by VCs and angel syndications? Look, I think that there remains a challenge with angel investing here in the region. I think that is something that to try and stimulate and grow, there needs to be some element of government support. I was just speaking to entities recently, talking about how the ability of the UK to have SEIS and EIS programs that provide income tax incentives as well as capital guarantees of investments can drive the underlying startup ecosystem. We go back to the point I've just made about family offices, even personal investors that will see potentially their investments struggling. Let's not talk about, and I see here a question around failure rates. The challenge of this environment, if an environment of startups which has been built not just in the region, but globally, but specifically in the region, you can speak to a grow at all cost environment. Many companies are having to shut down, cut costs, reduce team sizes. That has a big impact on the company. That information is being reported back to angels who begin to get worried about the growth of their investment or the opportunities of their investment. Naturally, that makes them more risk off. And again, we go back to the crowding out effect of the investment environment. If it's easier for you to put it into a fixed deposit than to make that bet into a startup that you're not quite sure is going to succeed, there is a risk-off mandate. And therefore, being able to catalyze and stimulate that environment where interest rates continue to rise is something that is key from a government perspective. Murtaza, is there any data to indicate how many startups have closed shop in the past 12 months? And similarly, there is a question, yeah, exactly, in the Q&A. Thank you as well. Look, there's also a question from Harish. What is the percentage of the failure of startups in MENA region? Look, anecdotally, I tell you one thing. From the Pakistani ecosystem on in several group chats, and we were discussing it with the team today, there's a lot more transparency when companies fail than there is in the MENA region. Now, we run an algorithm on the platform every so often, probably every 6 months, where we go through the social media messaging, the website of the platform, along with a few other algorithms to understand the activity of the website, and then put that on the platform and put active and inactive. I don't have that figure for you right now. You can use the platform to be able to calculate that. We will be doing a research piece in the coming months around that. But it's true that the other question that I've been asked from government officials in the last couple of days is, what's the so what of the current slowdown in investment activity? And what do we believe to be the biggest implications? And the reality is, in this environment, if you are unable to raise funds and unable to get investment from other parties, then it is very likely that we see an acceleration in the failure rate of startups. In fact, anecdotally, for a client that asked us about how many companies, the direct question was, how many Series A companies in MENA had raised Series A in the, so we went back 24 months to July 31st to identify how many companies had raised Series A prior to July 31st that hadn't raised the Series B, and we identified 225 investments. That means 225 Series A companies that had not raised since. So the question becomes, are they likely or able to raise a Series B, or is the consequence of that cutting their burn and waiting another 12 months, or naturally, is there a shutting down or M&A activity that takes place? Nosson asks, how do you position VC ecosystem growing in Saudi MENA versus advanced markets? Well, I think I highlighted in the presentation that there's a almost parallel slowdown in investment activity in MENA and in Saudi compared to other markets. Saudi, it's great to see the investment activity. It's great to see the government support. It's great to see the opening up of the country and the opportunities that it presents. But we call a spade in so much as I mentioned 65% of the capital came in 2 deals, and the levels of Q2 were lower than we have seen in several years. So even these geographies are not immune to the venture capital impact as we have seen in terms of global trends, and we will be looking to global trends. even publications or competitive publications that have seen some fluctuations in funding have pointed to the push towards AI companies, the push towards fintech companies being outliers of the underlying ecosystem. And again, the outliers here are somewhat conflicting the messaging of some of the geographies. How do due diligence processes get impacted in difficult environments and time to get funded? Capital efficiency and unit economics becoming paramount. Absolutely. I mean, again, I'm not a VC, so I don't want to speak on the behalf of VCs on how they do their due diligence process. But I do believe, and anecdotally speaking to VCs and listening to plenty of podcasts, I think you could hear Jason Calacanis saying term sheets were signed in 2021 and 22 in the frenzy off the back of an envelope, off the back of a valuation, with absolutely no due diligence being done. In this much riskier environment and risk-off environment, clearly each investment deal is being scrutinized, whether it's teams, whether it's corporate due diligence. I mean, when you talk about some of the companies that are failing, you're understanding it's mismanagement of funds, you're talking about corporate governance, things like that come under much more spotlight and scrutiny than they would have been 12 to 18 months ago when the hype was to try and get into any company. And therefore that due diligence process, understanding who the competitors are, how much have they raised, what revenue are they making, how big is their teams, things like that becomes much more under the spotlight in this current environment, which are some of the metrics that we're able to support with in identifying the market, identifying the competitor, identifying the investors so that you could potentially reach out to them and understand the growth of those companies becomes a lot more paramount. And again, I go to the point that naturally, if you delay the process in some cases of companies that are not unit economic and cannot show a path to profitability, are desperate for cash, the valuation is likely to go in favor of the investor. What level of investment or interest are we going to see in startups building products, generative AI, GPT, stable? Okay. So one of the challenges that I have with AI and that part of space is that in many ways, AI is a feature rather than a business. Now, clearly, there are some businesses that are AI focused, but in many cases, a lot of companies that can be in fintech, that can be in transport and logistics, that can be in other industries are embracing AI to further develop their companies. So it's very difficult, although we're potentially working with a client to bring out a report on this, to identify AI-specific investments versus companies that have embraced AI to further develop their companies. So it is a challenge for us to be able to track that objectively, but it's something that we're trying to embrace and better understand. Is there any data set reflecting the type of investors participating in VC, i.e. family office institutions? Are there any skewness in countries and regions? Well, absolutely, Mohammed. If you go on the platform and get access, you can actually filter all of the investors by industry, by country, by sector that they're investing in. They're broken down by type. I don't have the data here. Feel free to reach out to the team and they can provide you a demo of the platform to be able to answer that question. I'll ask the team to share the enterprise page where you can submit that request. Unfortunately, I don't have it with me right now, but you can do that on the platform over years by geographies. Anonymous attendee, great session. Wouldn't lower valuation environment be a better M&A? Why do you think the number's saying differently? Well, that was the point that I was trying to say. Yes, naturally, you would assume if valuations are coming down. But lest we not forget, there's two sides to every coin. And founders will find it difficult to accept lower valuations. So there is an element of an ecosystem. And for any acquirer, you need to have the buyer accept to be sold. But naturally, there aren't that many buyers out there in this environment. So if valuations are going down, they are still going to be expensive. They are still likely to be a cash element to it. Not many people have the balance sheet to make that acquisition where there is less and less funding. Historically, we've seen big tech companies acquire smaller tech companies. If they're not raising funds for inorganic growth, they're not able to make the strategic acquisitions. So they tend to be corporates that have big balance sheets or much bigger international companies. But again, if you just wait 6 months or 9 months, the risk will be for the founder and potentially the risk for the investor or the acquirer is that the valuation will go down, or if the company is to continue to perform well, that the valuation will go up. So there is a lot of emotive discussion around valuation, but yes, one would assume that you would see more M&A activity, but that seems not to be the case in numbers, and there seems to be a delay as these conversations are likely to be taking longer to go through. Why is there less transparency on startup failures in the MENA region? Absolutely great question, Harish, sorry. Anecdotally, in our culture, in the Middle East, it has tended to be a shame to talk about failures. I'm not here to be a psychologist to talk about why that is the case, but that is inherent. Sometimes there is a stigma to the failure of the VCs and the wider community, or even the geographies, governments that have supported those companies. We're not in an environment where people can criticize. So an open part of failure is to understand what didn't work. That could be the founders, that could be the investors that invested in them, that could be clients, that could be the board. There are many reasons that there is a failure to a startup. At some point, to be transparent around that, you need to be able to acknowledge or point to what those challenges are. That can create legislation and legal issues and a sensitivity around that. Whereas in other jurisdictions, people are less sensitive. In the US, there's a much more open and embracement of learning of those failures. But yes, some of the points anecdotally from my perspective as to why. In your opinion, how would you develop the situation? And I'll go back to that point. There is a lot of reading. There was a great piece, not so much a failure, an acquisition from, I believe, POS Rocket that was done by Ziad, which was excellent in that space. Every time there's articles in the Pakistani ecosystem of failures, there's a lot of transparency around that. So you can find some information. It just seems to be relatively thin here in the region. In your opinion, how would it develop the situation with migration of startups from Egypt to KSA? Would it affect MENA visa ecosystem? Look, I mean, ultimately, it's not a bad thing. I mean, obviously, it's frustrating for companies that are based in Egypt that are looking to move. I think the positive thing is to say that many geographies in the Gulf are looking to attract startups, develop the ecosystem. They're looking to attract the talent, and naturally that will come with investment. It may be very frustrating for the Egyptian ecosystem that look to develop that. I know that there was a lot of frustration in the Lebanese ecosystem when there were many of the challenges that they had at geopolitical and economic level that companies were having to migrate out to be able to continue and drive. But in the end, for MENA, we want to see a flourishing ecosystem. So the more companies that are able to survive, migrate, grow, hire, become a success story, which ultimately is what we're all looking for. More and more success stories to drive founders, investors, governments, international participants to come and continue to invest in this space. And this is genuinely a call out to governments that this is the time where policy and investment needs to be done to continue to put in money into the ecosystem for all the hard work that's put in the last couple of years. It's in this economic downturn that you want to support to continue to see growth, not when the good times and everything's rosy, that we can see how we can support many of these companies. So do I think that it's likely to change the transparency around failure? It's not for me to say. I think that it's for people to feel comfortable. I'm not pushing people one way or another, but ultimately transparency is positive. I realize there's 5 minutes left. I just want to make sure if there's any other further questions. I'll ask the team again just to share a copy of the reports. We have both an Africa report that was published. We have a MENA report that was published. We have our client reports for MENA. Next week, we will have a UAE and Saudi report. We'll have an investor ranking report, as well as a valuation report that will be published in the coming weeks for our clients. But this is the suite of the publicly available reports. And again, the link has just been shared in the group chat. Please do download that. Please do reach out to our sales team if you would like access to any of the tools. Please do reach out if you would like a free demo of the platform. We're happy to support you. We know that we can, as I always say to the team, we are half the price of our international competitors with double the amount of data. So if you're looking for a tool to support you for anything from Africa, the Middle East, Pakistan, Turkey, and Southeast Asia, as we continue to consolidate the emerging venture market space, please don't hesitate to reach out. I wish you all the best in the months ahead. I hope to see you if you'll be around at GITEX, if you'll be at FII, if you'll be at any of the events that are coming up. I love feedback. Please do share any feedback that you have that we can improve, and we'll be more than happy to support you in this current environment, which is challenging. Wishing you all the best, and thank you very much for your continued support.